So on this trade, we're actually going to be buying insurance. And I'm picking a stock, Salesforce, that I'm long. I'm long 100 shares, and I'm long from just over $69 per share. So if we see where it's trading, it's right at $93. I've got a really nice gain in the stock. And again, I want to be able to sleep well at night just in case the market rolls over or CRM rolls over. So if I look at the market, so this is the triple Qs. This is a lot of tech stocks. CRM would definitely kind of trade similar to this. I think that, tech right now is a little lofty and could potentially suffer a setback. So again, I'm kind of thinking along the lines that, why not go ahead, protect these gains just in case the market does pull back. Let's go ahead and look at the options grid. And remember, we're talking about buying insurance. We're going to be looking to the right of the screen over here, and that's where those puts are. Now again, the stock is $93. I'm long from 69, so I have a pretty hefty gain here. But the thing is how long do I want that insurance for? So I'm looking at roughly a little bit under a 1-month option. So this is the October expiry. And again, I can always double check that by looking here, knowing that this isn't a weekly. I like to trade monthlies. So I'm going to do the October monthly. And again, 23 days till expiration. So I don't want to pay a ton in premium for this protection. And so now I just have to look and say, okay, where am I willing to sell my stock? Where do I want that protection level? So we're at 93. Let's go ahead and look at the 91 put. I'm not willing to sell my stock lower than 91 out until October expiration. So let's go ahead and look here. So the market is 96 at $1. So it looks like the spread has come in a little bit. So we're at 95 cents at 98 cents. I want to do a little bit better than the offer if I can. So I'm going to use my limit as 97 cents here. Let's go ahead and submit this. All right, what happened? I'm now the best bid. Looks like we just had a trade. So I bought the CRM October 91 put, paying 97 cents. So let's go ahead and look at the risk profile of what I did with this trade. Now remember, I'm long from just over 69, so we're going to call it right around here, which is actually a really good level whenever you look at this chart. It's definitely in the lower tranche of where the stock is actually trading. Now, what we did is we bought the October 91 put, and remember it expires in 23 days, just over 3 weeks. So let's kind of mark where 91 would be. All right, so what is going to be my effective sell price? Remember, when we're talking about puts, to get your effective sell price, it's going to be the strike minus the premium that was spent, which was 97 cents, equals 90.03. So 90.03, we'll call it right around here. This is worst case scenario, people. Worst case scenario is I'm long from roughly $69, and my worst case scenario, at expiration, we're talking about October, I would have an effective sell price of $90.03. You're talking about a 30% gain is my worst case scenario up until October expiration. I like 30% gains. Let's go ahead and also talk about what the downside might look like for this trade. Well, since we're talking about $91 as the strike, if CRM is above $91 at expiration, 2 things are going to happen. One is I'm going to lose all of the premium that was spent, which in this case is 97 cents. One contract represents 100 shares. It's $97. That's all I'm going to lose on this trade. That's the worst case scenario that I can lose for this put. Also, because I'm long the stock, if the stock goes up to $100 at expiration, I'm going to participate in that, right? Because I'm long 100 shares of CRM. So if good things happen to the stock, that's okay. I like making money. If bad things happen to the stock, my worst case is is I've made 30%, I've locked in a 30% gain. So let's go ahead and talk about how much is this put really costing me, and I like to annualize things. So let's go ahead and look at that. So the premium, $97, and the notional of the contract is $9,100, right? Because we're buying a put, it's the right to sell stock, it's a 91 strike, we're talking about 100 shares, it's $9,100. This is going to be just over 1%, 1.06% to be exact, and this is talking about just over 3 weeks. Now, if we annualize that, how much am I really paying for this type of protection? It's roughly around 17%. So whenever we look at this in terms of annualizing it, 17%, it's not terribly expensive. It's kind of in the middle here, and I'm okay with that. Because remember, what's my upside? Well, if CRM keeps going up, I'm going to participate because I'm long the shares. However, I get to sleep well at night knowing that the worst case, my downside, is that I'm going to realize 30% on the whole trade package.